Hello and welcome back to The Note, and I hope our US viewers have had a good Thanksgiving and are looking forward to a good Black Friday. Now, while the US has been on holiday, here in Europe trading has gone on as usual, and in the UK, which we're going to concentrate on today, we've seen that sterling has actually reached above $1.63. Means that it's actually up for the year, and it's virtually a high for the year. Meanwhile, the FTSE 100 index, the main share index for London, is continuing to perform very drably compared to other developed markets. With me now to explain what's going on is our global market commentator, Jamie Chisholm. Jamie, thanks for joining me once again.
No problem.
Let's start by taking a look at sterling. Now, it's been obviously a year of two halves, particularly dramatically against the dollar. It was the arrival of Mark Carney at the Bank of England with his forward guidance, which is supposed to really shoot sterling between the eyes, seems instead to have been the moment when sterling took off.
Yes, a bit of Canadian magic, eh?
Yes, what's going on?
Well, as you can see, yes, sterling has taken off. Back to the level it started the year at against the dollar, rising against the euro. The reason for this is mainly because people perceive the UK economy as being one of the fastest growing in coming months of the OECD nations. So obviously that's given a boost to sterling. We've had commentary from the Bank of England, which people now believe means they're potentially closer to tightening policy than many other developed markets. Whether that will turn out to be true, we don't know.
Right.
But anyway, for the time being now, sterling is rising on the back of this. And
to some extent, the forward guidance, which was meant to show that rates were bound to stay low for a long time, given that all of the conditions on economic growth that were in there, in fact, is now more or less suggesting that rates are due to rise ahead of those in the States.
Yes, and we've not seen a massive move in bond yields, for example, either in short or long-term bond yields, but they are creeping higher. And it seems to be that the way this is being played out mostly in the markets is via sterling. It's a question of, in a lot of other currencies, are not particularly attractive to investors, right. So they like sterling.
Okay, now let's take a look at UK stocks. So they might like sterling, but that doesn't seem to show up at all when you look at the performance of the FTSE 100. This is in common dollar terms compared to the S&P or to the euro first. Why isn't there that?
Well, that's right. Well, the FTSE 100 for many people is considered quite a good gauge of the global economy. It's got global miners, it's got global financials like HSBC, for example. But the problem for FTSE 100 is, whereas it's relevant to the global economy, it's based on a currency term which is relevant specifically to the UK economy. Right. So when the pound rises, all those dollar earnings, it means the earnings for dollar earners, right. It becomes more difficult. And as you can see, the S&P 500 is up about 27% this year. The FTSE Euro first is up around 100 and...
About 17 or 18%.
Sorry, yeah, 17%. But of course, that includes a big chunk of the FTSE 100. If you look at the DAX will be about here as well.
Right.
The FTSE 100 has been lagging. It's half the gain of the S&P. The miners have struggled.
Right.
I consider a lot of oversupply in mining. The oil price has not really gone anywhere.
Right.
The UK-based financials have done a lot worse than US-based financials, which seem to, even with the pressure they're facing, the regulatory pressure they're facing, seem to have got their house in order in terms of their book better than the UK financials have. So all in all, it's a pretty miserable performance from the FTSE.
And what's surprising about that is that the currency has been strong, and that's been because of the strength of the UK economy. Perhaps what we should be ramming home is that the UK economy has almost no relevance at all then to the FTSE 100.
Well, very little. People would tend to look at the FTSE 250, which is the one just below the 200. Although today, for example, another example of the FTSE underperforming, it was originally higher when there's a little bit of a rebound in some of the miners, and we hear from the Bank of England they're stopping a funding for lending programme. Some of the builders, which are quite UK focused for the FTSE, then sold off, and it's underperforming the European market yet again. There's these big sectors which keep getting whacked by various regulatory things or global economic things, and it's really not helping.
Okay, Jamie, thank you very much indeed. I think this underlines what we often need to say, which is that the performance of a stock market and the performance of an economy really aren't that closely linked at all, at least in the short run, and particularly in the case of London, because of course the FTSE 100 really has very little indeed to do with the UK economy.